Money, school, TV.
Hi, everyone. It's Tess Hulack, and today I wanted to talk about reserve redundancies and premium returns. For those that don't know me, I am a 30-year premium financial reporting accountant. I reported the financial regulatory statements, and through this journey, it was something we joked about on AMA earlier this week. I never really understood or learned this process. And when I did find out about this process, I jumped ship from behind the desk and came front and forward facing because I want to share what I know from being inside the industry and learn and continue to share what I know with those that are trying to become a part of this process. And it's a beautiful tool that I wish I had known about sooner. My only regret is not knowing sooner. And I myself have been involved for over 5 years. All 3 of my policies are into year 6 right now at this time. And for those that have heard a little bit about that thing called the vault, I was playing in there, not playing, but I was in there this morning because I uploaded current illustrations and was printing out information. And there are some beautiful tools. The one thing I can tell you about being around this campfire for so long, and I wanted to say being around this campfire is pretty amazing because I've watched changes. This doesn't stay stagnant. They're always looking for how can we better educate? How can we better provide for our clients? How can we better reach more clients that we don't even know are our clients at this time? It's a never-ending journey to try to service more people and help them to take back control. And that touched my heart in such a way that I did leave behind the desk of 30 years and I came front and forward facing, hoping that I can reach other people. And for those that don't know, if you go into MSTV in previous weeks, I've talked about audits. I've talked about the legal representation inside of insurance companies. I've talked about premium writing controls and reinsurance. And I probably could do more with reinsurance because that's a big, huge area and a big piece of a financial statement on insurance companies. And then I talked about AM Best ratings and how even though they have no regulatory oversight, they can really cause you to run in circles fast because I've experienced it. And that's what's kind of I like to do here is to share the things that I've experienced from the inside. Because I was there when one of the small companies got taken over by the state. I was there when an AM Best rating hit a B paper and we had to take action. So I've seen it and I've seen how the companies react and I see how they come out of that and stay strong. And in a lot of ways, it's not even visible to the client. So it provided me with an income for over 30 years, and it provided me confidence in the stability of my job. So today what I wanted to talk about is insurance companies are conservative by design. And by talking about that, what I want to talk about is why there is something called a return premium or like return premium redundancy, or why there's reserve redundancies. What causes the need for this? And is this bad planning or is this good planning? Because often I hear people talk about that thinking it's not necessarily a good thing. But I disagree with that because I know we're working with a product that has a tail. And by tail, they mean if you write a policy today, it could take 50, 60 years before that permanent insurance policy ever has to pay $1. So do you want somebody who is playing in the stock market and praying that the day you need a paycheck, it's going to be there? And again, the financial advice, we can't give any of that. I know you guys signed disclaimers, but do you want stability, guarantees? Chris always talks about guaranteed. Do you want guarantees? Do you want conservative? Or do you want iffy? I understand that when these permanent life policies are gone, you're not going to be there to witness it. But do you want to look down from heaven and say, I let my family down? No. So this idea, what I wanted to say is, why is this done on purpose? Have you ever wondered why insurance companies do this on purpose? Why do they hold back more money? Really, it is conservative and it is for long-term purposes. It's a strategic, protective move. It is because of the long tails and the idea that whole life policies are permanent. They will pay out. Like Chris has talked about often in the trainings and on AMA, term insurance, only 1% ever pays out. So they don't have to charge as much as it would be for a whole life policy. And they're going to disappear at some point in time. You don't have the same benefits with a term policy that you do here because there's one day they're gone. This whole life policy is going to one day pay out. So you want to know they're conservative and you want to know they're protecting you. I think that what causes people to be confused is it makes them feel like they're overpaying. And one thing I want to talk about again, and I know I've said it in previous things, is that we as a team generally work with mutually owned insurance companies. So what does that mean to somebody that's new to this area? Mutually owned means we as policyholders, all of us who have a policy that's going to pay guaranteed somewhere down the line, we are mutually owners of the company. So anything that the company does, bad or good, comes back into our profit and loss, which ends up redistributed back to us in the form of, say, what people are calling return premium or the profitability of the company. So the idea is that since we're mutually owned companies and we're conservative, you're still going to be okay, because if the premiums are up or down, it's going to come and reflect into you. But we want them to be conservative because we want to know that at X date, when you're no longer here, it's going to pay out. And what happens with this idea is, do we just arbitrarily pick a number and then leave it that way? No. But what you have to realize is that when you're writing a whole life policy, your premium number is written, and it's written in contract from now until the day it pays out. So there's no adjustments to that premium. I mean, unless you're writing like some of these IULs where like Chris has talked about, he had to go sit at tables and say, unless you have 6,000 to put in, your policy is going to fold in on itself because it can't make it didn't make what they thought it was gonna, or what you thought it was in the market. It's not like that. These are guaranteed. The person on the hook for making sure you get paid is the insurance company. But the beautiful thing is you're no owner of the insurance company. So there's all these guarantees all the way around, two ways. And I can speak to kind of both sides of it, the life side of it and the property and casualty side of it, because I spent, and actually medical malpractice, because I spent time in every arena. But basically what we do every year is we take a look at, because when I was doing analysis, I would look at policy year, line of business, I would look at region, try to determine what was driving losses. If it was property and casualty, if it's life, it could be impacted by, say, catastrophes like floods or fires. There could be an increase or a spike in death losses because of that. But you always want to take a look and say, okay, what triggered it? Is there a frequency issue? Is there a severity issue? What caused the movement in this industry? And then what happens is you put your analysis together and you go before the board and you say, hey, this is what I found. Do we need to make adjustments to say what we charge in premium next year? And even that's not cut and dry. Once you decide you're going to have to make adjustments, you go to a regulatory board that you are actually insured under, and you have to say, this is what we want to do. Do you agree or disagree? And they can say, yeah, we agree. Our policyholders are protected. Or no, let's take a look at this section. We don't like these modifications. Let's adjust them and then we'll approve your rates, because rates are approved. They're not just willy-nilly, hey. I mean, it appears some of that to the real world or the person outside of the industry, but there's always Big Brother. And I've talked about Big Brother many times throughout this process. He's always looking, but every year annually, sometimes more frequently, if we know there's a lot of action going on, like if there's a lot of floods, a lot of fires, a lot of mining accidents, because anything that could have caused fluctuations, we need to take a look at that and maybe adjust sooner. How often can we readjust our premiums based on what's happening in our book of business and based on what we're going to have to pay down the road, because all of that is predicted from day one. And Chris will always talk about that, Chris and Stephen, that they know, kind of predict when you're going to pass away, and they're always looking at that, and they might have to make adjustments based on these catastrophes that happen. So they're actually conservative by nature because they have to insure and protect you against worst case scenarios. So if no worst case scenarios happen, what do? They say, hey, we're profitable, we're confident, we've had the actuarial review, we've had the audits, we've had the outside actuarial reviews, we've had the outside audits, we feel that we have a little bit of extra, we have some extra, let's pull it back in, it's our profit, let's roll it back out to our policyholders who own the company in the form of return premium. And that kind of is the same method with reserves on, say, property and casualty, like your auto insurance, that kind of stuff. The difference with your auto insurance and some of those general liability policies is you'd really have to look at who owns the company. Most of those cases, you're not an owner like you are in whole life. It may be a publicly traded company, it may be a privately owned company, but if it is mutually owned, and there are some of those, because I worked for mutually owned property and casualty companies, you're a stockholder, so you benefit from it. So these are all good things to know. I know it can be complicated. A lot of this does come up in the other talks of the other lives, but the idea is here, you're protected. Internally, you're protected. And the idea of return premium is actually an indication of a company that's run taking a look at all possible worst case scenarios. And then if a period of time goes by, like there's always what they call a tail in business. I know that in my days in the insurance industry, say an automobile had an accident, they would say that it might take up to 3 years for a physical damage claim to be settled, to say that that tail had ended, that there's probably not going to be any more claims for this car that had its fenders and its windshield and trunk is gone. After about 3 years, those claims are all closed down. So if you have any reserves for that accident year, you can kind of close them down. So they have tails, and based on studies and based on analysis for hundreds of years, they kind of know what these tails are. And that's when they evaluate and say, okay, let's pull in some of this conservative because we're not going to need it and give it back to the people that own the company. And that happens with like liability claims. So say you're in a car accident and your car is damaged. They say it takes about 3 years to the tail of that car being repaired, but it'll take about 7 years for liability in case you're injured. You have a head injury, you have to have surgery because you hurt your arm or your leg or something like that. They say that tails 7 years. Now, liability can go a lot longer than 7 years. I'll actually share stories here from like the state of Michigan. And this is property and casualty, so I'll try to say it closer or not spend a lot of time on it because this is actually life insurance, but it's probably interesting to understand the industry as a whole. We have something here in the state of Michigan called Michigan Catastrophic Claims Association. And what they did is they said, hey, an automobile accident could cause something that's going to last a lifetime. And so they put together this fund called MCCA so that if you're injured in the state of Michigan, you have unlimited bodily injury. And that's important for, say, when I was in the industry, we had a claim for a guy, and this was sad, but he was probably about 20 years old. And this has been 30 or 40 years, but 30 years, because that's how long I was in the industry. So it was early on when I was in the industry. But he was in an accident in his early 20s. He had been really freshly married, barely 20 years old. They're in a car accident. He became a quadriplegic, so no arms, no legs. His wife died in the accident. So basically, he was 20 years old, and he had the rest of his life that he was going to have to need services. So this bodily injury had to be available, and Michigan provided this as an extra service that's an extra insurance that the state of Michigan provides. But the reason I bring that up is what happened during my time there is there was a point where they had been so conservative because that's an unknown and they had some frequency. So they decided to up the rates, and it got to a point a few years down the road where they're like, we think we overestimated that. Let's give some money back. In this particular case, it became complicated because you had to go to all these insurance companies, declare a date, and then give back a certain amount to all these policyholders and try to track them down. And what you'll find is that when you're trying to do it that way, people, and I don't think she's on right now, but Lisa, she's been on with us the past couple of weeks, what you'll find is people get these checks in the mail and they're afraid to cash them because they don't know what they're for. And that kind of was what it was about, which means that for me, the idea of a mutually owned company where we get to own it and it just comes through in the dividends into our policies, that's really kind of a nicer way to do it. It's all managed within the company. And if you ever want to attend a board meeting as a mutually owned company and you happen to be in the area, every company I ever worked for invited the policyholders. If they were publicly traded, they invited the stockholders. And if they were private, then they invited whoever was the private owners of the company. So if you ever want to attend those meetings, hey, you'll get free lunch and snacks and you get to see where the company's headed or learn a little bit more about insurance. But that all stays internal. And I think that's what's such a great thing about it. Yes, they're conservative. Yes, they overestimate. Yes, they review it on a regular basis. Every September, we know that it's review time. Let's take a look at the premiums. Let's take a look at our reserves. Let's do some takedowns. Are any of these claims, like in the case of, say, life insurance and property and casualty, I'm sure you can see that there's probably a lot more expenses that may be harder to explain, like lawsuit costs or adjuster costs or depositions, all those fees. a lot of those can come back in down the road. In life insurance, you're probably not going to have so much of that, but you might have some reserves for, say, legal fees. What if there's a contesting of who gets the money, and they have to spend some money trying to do some due diligence to figure out, a legal part of all that. So there might be some areas there where they might be able to make some adjustments, but all of that comes back into the pool of profitability and is passed out in dividends. So it's a win. It's all the way around a win. It doesn't mean the company was wrong. It just means the company was prudently cautious. And I think that's such a great thing. It also, we don't have a statute of limitations per se on life insurance, and the statute of limitation is like for property and casualty. If you have a car accident and 7 years pass, that's probably the time where you're not going to be able to file a lawsuit. So you're not going to get a lot of new claims. For life insurance, it's life. It's going to pay out at some point in time. So that's another part of it that's really nice, is that there's not going to be quite as much unexpected. You're not going to be able to predict catastrophes or severity that might be caused by catastrophes. So there's narrower things that could fluctuate, but there are things always that could fluctuate because we just don't know. Oh, and I kind of mentioned this last week. Another area where this all comes into play is even the idea of you have rating agencies, and I talked about that last week, like your AM Best and your Moody's and your S&P. Now for insurance, it's predominantly AM Best, and based on like these reserves and stuff, even them, they're going to be looking at it. And if we're more conservative and we're taking back money, that's more of a positive reflection that we're conservatively running the company. If it looks like you're always behind the 8 ball, when these rating agencies are taking a look at you, you might take a hit for that. And like, I'll briefly say it because I kind of explained it in more detail last week. Even though a rating agency doesn't have the ability to close you down, they can influence public opinion. And when they influence public opinion, they can create havoc within your organization. Because I worked in an organization that did not have regulatory oversight, but we had to take action because AM Best downgraded from A to B, and it was during the time of like the 2008 mortgage crisis, and we had to take on these additional reserves deemed necessary by the NAIC as a result of all those mortgage-backed security things. So through something unplanned or unknown, we took a hit to our paper. Even though it did not create regulatory oversight, it created B paper and the need for us to go to an outside organization or another insurance company and reinsure the whole book of business, until about 3 years later, we were able to bring the paper back up to A paper and bring it back onto our company name. And really, it protected the policyholders even more, because not only did they have our stuff that they were being audited over, but everything had to be audited again under the company name it had. So everything about this is a good thing. I talked about MCCA, and I guess I'm going to just say a couple of things about infinite banking. I think that this is important for us because we're looking for stability. We're looking for the idea that 50 years from now, 60 years from now, even though we're not here, the people that we love are protected by these policies. Because although we're writing banking policies and we're worried about the living benefit, somewhere down the line, somebody wants to collect the death benefit. So we're focused right now on that living benefit. But one day you want to know that death benefit is going to be there. So that's why these conservative companies are the kind of company that you want to partner with for your IBC policy. That's why you want a team like this team to help you, because we know what companies have been doing this for 100 years, 200 years. Most of the big companies have been around for over 100 years, at least in my experience. Some of the smaller ones, not so long, but we know the details, and we have the relationships so that we can work through and get what you need as the best possible policy. We also know that because they're long-term companies, we know they're mutually owned. We know they've been paying dividends for 100 years. We also know that the long-term guarantees are responsible guarantees, something that you can count on. And the strength of your policy is backed by layers of conservative planning, conservative auditing, and rate controls. And I mean, everything I've talked up to this point. If I was to tell you, I should tell you that when I first entered this industry, after spending years in college learning accounting, the first thing they told me when I went to because I went to all the conferences, I wanted to learn. I knew this was going to be what I did for the rest of my life. So I wanted to learn. When I walked into that first training session, after I got hired by an insurance company, the guy at the front said, forget everything you've ever learned. We don't operate like the average company. Yes, we'll look at things by a going concern, which means we plan to be operating tomorrow. But in the insurance industry, when we're reporting regulatory, we like to call it liquidation based. We want to know if we close the doors today, that every claim that could possibly come out will be paid out. And that's also kind of known as statutory accounting. So these are terms that you don't really have to know, but I had to kind of learn statutory accounting, which is kind of like liquidation. If we close today, what's that going to look like? GAAP accounting, generally accepted accounting principles, all these things that are controls over the people that have your money for 30, 40, 50, 60 years. And I think that makes them the tools that you want to use when you're writing these infinite banking policies. It gives you the strength, it gives you the confidence. And for me, it gave me a career, and it gave me the ability to share what I learned in that career all these years later. So really what I want to say is insurance companies are required to think in decades, not quarters. We have to report in quarters and we have to report annually, but we got to be foresight and be looking for decades out. Reserve redundancy isn't wasteful, it's wise stewardship. Return premium and reserve releases are signs of a good health company, not weakness. That means they're doing things and they're doing things right and they're improving so they can release some because they did the job in a very, very positive way. These practices allow for strength through recessions, pandemics, and market crashes. Because like I said, what was the worst thing that happened to me? When I worked for the company that we had no regulatory oversight, when AM Best downgraded us, it caused us to have to take action. And yes, we probably paid about 5% for our entire book of business for 3 years till we got ourselves back to A paper with AM Best, but that was the only impact. And you know, when all that went down, a lot of people lost jobs. There was a lot of change. And in my industry, it was business as normal with a few little hiccups in the road, and we just kept going. I was never impacted by that. If I was to tell you, when I went, the headhunter that told me I needed to get in the insurance industry because I'd have a job for the rest of my life, I always say if I could find her, I would thank her, because after that first job in insurance and I learned my skills and I got my credentials, I never interviewed for another job. Somebody would say, hey, we know who you are. We have something here. Do you want to go? That industry is so tight, so knit, so close that everybody's kind of watching everybody else. And I think that provides a security we all want to know. It's why we trust mutually owned companies with our long-term financial goals. And I know Lindis has been putting in there, if you want to work with Lindis and I, we're working with clients, trying to help them write their policies. I do have a little different perspective because of the background of it, but I'm excited to share this with you because I never knew 30 years ago when I walked in the door of that first place, what kind of a stable environment I was walking into. I never went through the fears that a lot of people I knew went through, wondering if, I still had the doubts. I knew I was in a stable business and I still thought, what if something goes wrong? But in all those years it didn't. And still to this day, I hear from people saying, do you want to come back? But for me, if I can help you guys to have the confidence so that you can take back control, so that you can create your bank, and also know that in creating your bank, you still have a death benefit that's going to benefit someone later. And even though you're not here to scream if it's not there, they're stable enough that you can rely on the fact that they'll pay that out if you're not here one day. If there's anything that I said that didn't make sense to you this week or in previous weeks, please let me know, because I did live it for so many years that sometimes what makes sense to me may not necessarily make sense to you. But this is a passion for me. I want to help people understand what a beautiful, secure tool this is, not only for the living benefit today, but for the death benefit that it will provide those that you love or the people that you choose to help in your life when you're no longer here. This is a tool that's a win-win. And if you put it into play with the PMC, you can create additional wins on top of that. So I believe in this so strongly that that's why I step behind to step up front, because I know the stability. To me, it's almost like Yeah, give me all the marble columns. And it's kind of funny because Security Mutual Life, when you walk into their offices, they're kind of set up that way. And when we walked in the front door, that to me felt like an insurance company. Big marble pillars, strength. They are strong. And they provided me for 30 years, and they'll provide for me into my later in life. And I hope that by sharing this, I help you to have the confidence to believe in what this can do for you, and give us an opportunity to talk strategy with you so that you can educate and maybe make the steps that will improve your life. If you want to book a call with us, please book a call. We'll be happy to talk to you. There are no obligation. It's just an opportunity to learn. I myself had to learn. It's a running joke, and you may or may not have heard this before, but I wrote my first policy in the first 6 months of lockdown, and I was on my own by myself. So I took my emergency fund as my dump in, and I wrote a policy. And I'm going to tell you, I was scared to death because I thought that what was I going to do if I lost my job, if this pandemic had already gone on for 6 months and they told us we'd only be out for 2 weeks, and I was putting my emergency fund in this policy, and I was scared to death. What if I don't get that check? What if it doesn't work the way they told me to? And I went through the whole process scared to death the whole time. Stephen Nagy was my mentor at those days. He's not mentoring now, he's kind of overseeing us all, but he was my mentor in those days, and I was scared to death. So when I got that first policy and I had the policy loan and it was mailed to my house, I went out to the mailbox, and when I opened it up and I pulled out the check and I opened up the check and I looked at it, and I'm like, it works. It really works. I never even left the mailbox. I'm on the main road here, guys. And I like stood out on the road and called Stephen and said, let's start number 2. And that's how my journey began, because I trusted, but I needed to verify, because I thought, how could this possibly work if I'd been in this industry for 30 years? And even when I talked to the people I worked with, they didn't understand. I keep trying to reach a hand out saying, when you're ready to learn, I'm here for you. But it's just like all of us. If you're not open to trying to look at something differently that you've been told your whole life, you might miss a golden opportunity. And I'm so grateful that I took that chance in a very, very scary time, because I didn't know who I was going to go to if things fell apart. But I'm so grateful I did, because if I could have, I would have gone back 10, 15, 20, 30 years and done this. And I wish I had known, but I can't undo what I didn't know. All I can do is make sure today I'm doing what I can do. And if I can help others along the way, to help the others. So if you're interested and you haven't booked yet, you definitely want to do that. And again, I don't see any questions, but if anything comes up, you can reach me at tess@chrisnoggle.com or linus@themoneymultiplier.com. And I am happy to help. If I didn't touch on something in enough detail, please let me know. If you want me to revisit something, if there's anything we can help you with, please set up a strategy call, and please reach out. We would be happy to help you. We know what it did for us, and there's nothing that we find more rewarding than to help somebody else down this journey. So thank you guys for being here. I am right on the money this time, not even a minute or 2 over. So I will hang this up for today, but thank you guys for being here. I appreciate your support more than you'll ever know. And we're here for you. If there's something we can help you with, please reach out. Thank you.
Money. School. TV.